Many understand the dangerous notion of central bank digital currencies, the ability to surveil transactional behaviour, while the programmable capabilities enable authorities, of course, to potentially prevent anyone's ability to even transact. They are a clear and present danger, but an even bigger threat to people's economic lives is looming larger by the day. And it is clearly taking shape across many nations that are experimenting with tokenization pilots. It is the single unified ledger. If a CBDC is seen as digital cash by some central planners, well, the entire operating system for value and ownership is the single unified ledger, upon which currency and far more will actually run. Yes, banknotes are intended to be replaced with digital tokens, but in addition, it's about redesigning the whole machinery of finance, identity, and economic behaviour so that it's all engaged in one programmable framework. This video explains what that means, hopefully in very simple, understandable terms, and why the average person may want to pay very close attention, particularly if you are aware of David Rogers Webb's thesis of the Great Taking. The single unified ledger is designed so that every dollar, bank deposit, government bond, mortgage, pension, shopping transaction, tax payment, and more exists and is entirely visible on one shared digital platform. Currently, banks all have separate databases or ledgers, and our activities take place across a variety of payment apps. This makes surveillability difficult to enforce, yet a single integrated system, one ledger, ensures that everything interoperates instantly and automatically. Now, that is the idea behind the unified ledger. In essence, it combines programmable digital money. Now, this will vary slightly by country, but it will include everything from central bank money, so CBDCs, tokenized bank deposits, and privately issued stablecoins by regulated stablecoin providers. Tokenized financial assets, which will include government debt instruments as well as equities and mortgage products. Smart contracts will then be able to automate transactions, and a digital identity layer will link people and businesses to their holdings, and this all offers real-time oversight by regulators and authorized institutions. So when it comes to tokenization of anything, and when we're talking about tokenized deposits, it is simply referring to a digital representation of an asset, which will include information about the asset, including its transactional history and rules as well, which could be related to how the asset is allowed to behave with regard to perhaps certain scoring metrics. It will also have the capacity to actually encode smart contracts, which will govern the token's behavior. Now, that could include conditional payments, such as payment is only made upon delivery. Crucially, what is being developed isn't just a CBDC or even stablecoin. It is actually a centrally coordinated financial ecosystem. So what are the intentions behind this? Well, the proponents of this, including BIS and central banks, argue that it will reduce friction, cut costs, speed up settlement, fight fraud, and modernize outdated financial systems. But beneath these stated aims lies deeper structural purposes that you will not see discussed in any BIS or central bank documentation. I've broken this down to 4 main points here. First, it helps to sustain demand for government debt. Now, if we take the current UK pilot as an example, together with regulated Genius Act stablecoins that's been announced in America, government bonds, that is government debt, are being built directly into the system. They will function automatically as backstops for stablecoins to be used as saving tools and collateral, which allows more debt to be issued upon. With national debt soaring, this ensures consistent demand for sovereign debt. In essence, people become perhaps even unwilling stabilizing agents for government debt. Now, for the main holders of government debt, the effective apex predators of the financial world, well, they'll get a brand new era of synthetic demand, which is built into the monetary rails and incentive structure of the unified ledger. This guarantees that interest payments will be made to the parasitical financial class when expected. Ultimately, our money and pensions will be more tightly tied to state borrowing than you actually realise. Second, the securitization of behaviour. Because everything on the ledger is programmable, financial access can be linked to actions. So if you pay rent on time, you get an automatic credit score boost. Miss a state obligation, well, maybe a restriction could appear. When financial tools and behavioural data merge together, well, everyday actions can become financially meaningful. Third, this system guarantees claims on future behaviour. Programmable money allows conditions such as spend this by a certain date, use this only on approved items, access granted only if certain criteria are met. Instead of being neutral purchasing power, and money becomes a guided behavioural instrument. Policy can be coded directly into currency. CBDCs alone are only part of the story here. Now the ledger is really the main engine. Fourth, and perhaps equally dangerously, is the fact that the ledger is built for function creep. Again, the UK pilot is revealing as it includes tokenization of the remortgaging process, which appears indicative of the longer-term desire to tokenize every asset. Initially, this will likely be the digitization of property titles and the tokenization of mortgages, but then this will expand to that of family homes and beyond. This is a systemic risk created by the convergence of digital ownership and extreme fiscal indebtedness. Now, where Roger's Web thesis really fits here is when a debt-based financial system enters crisis and all assets are digitally denominated and custodied centrally and visible in real time, they're programmable and dependent on the ledger, then when the system breaks, losses are likely to be allocated from the top down automatically and with minimal ability for citizens to resist, hedge or escape. So in effect, we could be turned into buyers of last resort for government debt and lenders of last resort to the banking system. The architecture heightens the structural vulnerabilities that David Rogers Webb points to in his thesis, The Great Taking. He identified that most people hold indirect claims, not direct ownership, and crisis resolution frameworks can override those claims. Tokenization and unified ledgers intensify these dynamics, making harsh redistribution in a breakdown more plausible to my eyes. And as we've discussed previously, this system is not really built to last. CBDCs rightly raise significant concerns, yet under their cover is a far more transformational shift via the single unified ledger. A financial ecosystem that will likely reshape economic life, personal autonomy, and covertly rewrites the relationship between citizens and the state. The lack of public discussion regarding this potential development I find deeply concerning. For if this all happens, well, many will be unaware of the profound shift that has actually been made behind the scenes to their banking apps, their account terms, and their revised mortgage documentation. Now, there's so much more to discuss on this because the dangers are profound, and because it is not in the news, a single unified ledger, after all, sounds so very dull. It doesn't grab attention. So please do share widely. Now, do consider checking out the other videos on the single unified ledger to dive into this in more depth. Thanks so much for joining me, and I look forward to seeing you next time. Bye bye.